as we were just talking about with Stuart, you parse out the Fed speak that we've been getting, and there is more concern, I think it's fair to say at this point, about the inflation trajectory versus what's going on in the labor market. Of course, it's not either or. You can be concerned about multiple things at once. But all of that being said, what are you going to be keeping an eye out for at 8:30 tomorrow morning?
Yeah, so I think there's a few things that I'm watching in the jobs report tomorrow. One of them is the jobs diffusion or the breadth of job growth. So, as we've been talking about in the previous segment, we are still seeing that job growth is fairly concentrated, particularly within the healthcare sector. That's not necessarily cyclical. So I want to see if that job growth is broadening out at all. I think the other thing to be watching is wages. That I think is very important for the Fed. Right now, they view the labor market, even though it's improved more recently, as in an equilibrium and fairly stable. And the reason that they assess it that way is because wages have been gradually trending lower. Despite the fact that, honestly, if you looked at what we thought would happen to wages given the immigration shock over the last 12 months, maybe you would have expected to see more tightness. But I think that you're not, because there is a reasonable equilibrium that's forming. And I would say the last thing is the U6 underemployment rate. That has actually been creeping up more recently. And so I just want to watch if that's going to stabilize or not. But in general, this report isn't going to help the Fed. The Fed is still really concerned about the inflation outlook. And what's really driving the inflation outlook right now is energy. And when you look at the correlation between rates and oil, it's remained very high, even as this conflict has persisted and equities have decoupled from oil.
And Kelsey, of course, we're heading into Kevin Warsh's first meeting as chairman, and we know that he is no fan of forward guidance. He made that very clear, especially in his Senate confirmation hearing. And there's a lot of questions about what the future of the dot plot looks like, whether we're going to remove forward-looking language from the statement, whether or not we're going to get fewer post-decision press conferences altogether. And I wonder, what you think the impact might be into the bond market, weaning ourselves off of that constant communication.
Well, to be fair, the Fed has been shifting away from forward guidance for quite some time now. So actually, this morning, I was looking at the number of words in the FOMC statement, and I was looking back at a few years ago, and there was a lot more words in the FOMC statement back then than today. And that's really just a function of the fact that we're moving away from the zero lower bound, that it seems like less of a possibility, even in the next recession when it does happen. We're not necessarily going to be cutting back to zero. And so a lot of these things that were created for that environment are no longer necessary. And so from that perspective, I think there may be more continuity than people expect, particularly on the dot plot. We know that he doesn't love it, but we also know that he wants to encourage debate. And so I don't know how he can say he would encourage debate and then unilaterally get rid of the dot plot on his own without consulting with the rest of the group. He wants debate. So let's have that debate and decide what to do. But in general, the market is already operating in a data-dependent framework. So forward guidance has kind of been out the window for some time now.